A new idea is floating around Washington. It sounds simple. It sounds like it could help people. The proposal is for a 50-year mortgage, a home loan paid off over half a century. The goal, lower monthly payments. That could make it easier to buy a home, especially with today's high prices and interest rates. A seeming quick fix to a big problem. But look closer. The picture gets concerning. Not just a small market tweak, a fundamental shift in financing the biggest purchase of your life. The idea was announced suddenly. It came from a social media post, not a formal policy rollout. Many inside the White House were surprised. Sources reveal frustration over how it was made public. It wasn't fully reviewed by senior officials. This lack of planning and internal discussion is a red flag. Good policy is rarely made in a rush. It requires careful thought. It requires expert analysis. It requires a clear understanding of intended consequences. It requires a clear understanding of unintended consequences. The hasty announcement suggests the process was skipped. This is not just another political talking point. It has real-world implications for millions dreaming of home ownership. It touches the core of financial security for families. Debt could last a lifetime, or longer. For many, a home builds wealth and stability. Changing the rules could reshape the economic future of a generation. We must understand what a 50-year mortgage truly means before it becomes reality. We need a serious national conversation. Is it a genuine solution to housing affordability, or a dangerous gimmick that could trap people in decades-long debt? The stakes are incredibly high. Look past the promise of lower monthly payments. Examine the long-term costs. Examine potential market distortions. Examine who really stands to benefit. This isn't just numbers on a spreadsheet. It's about the financial health of American homeowners for the next 50 years. The housing market is tough right now. There's no question about that. Prices are high. Interest rates have climbed. Many people, especially first-time buyers, feel like the dream of owning a home is slipping away. The average age of a first-time homebuyer has now hit a record high of 40 years old. It's understandable why politicians are looking for answers. They want to show they are doing something to help. The pressure to find a quick and easy solution is immense, but quick fixes often come with hidden costs. The 50-year mortgage is being presented as one of these solutions. The logic is straightforward. Stretch the loan out over a longer period, and the monthly payments will go down. This might allow more people to qualify for a loan and get into a house. However, this proposal fundamentally misunderstands the core problem. The issue isn't just that monthly payments are high. The real problem is a severe lack of housing supply. For decades, the United States has not built enough new houses. This shortage is what drives prices up relentlessly. Making it easier for people to borrow more money doesn't create a single new home. It only pours more fuel on the fire of demand, which could push prices even higher, and cancel out any benefit from the lower monthly payments. This brings us to the central question. Who really benefits from a 50-year mortgage? Is it the young family trying to buy their first home, or is it the financial institutions that would collect interest for an extra 20 years? Experts are already warning that borrowers could end up paying nearly double the amount in total interest over the life of the loan. This isn't a path to building wealth. It's a potential trap, a form of long-term financial servitude. Instead of helping the next generation, it could saddle them with a burden that they carry well into their retirement years, potentially into their 90s. The main appeal of a 50-year mortgage is simple and powerful. It promises a lower monthly payment. For families struggling with high living costs, this can sound like a lifeline. Imagine you are looking at a house you desperately want to buy. The bank tells you the monthly payment on a standard 30-year loan is just out of your reach. Then, a new option is presented. By extending the loan term to 50 years, that monthly payment drops. Suddenly, the impossible seems possible. You can afford the house. You can move in. Your dream of home ownership feels within grasp. The 50-year mortgage takes this principle to an extreme. It adds 20 years, 240 extra payments. This focus on the monthly payment is a clever marketing tool. It shifts the focus away from the total cost of the loan. and puts it squarely on short-term affordability. Let's put some real numbers to this proposal. Imagine you want to buy a home and need to take out a mortgage for $400,000. For this example, let's assume you get an interest rate of 6.5% for both loans. With a traditional 30-year mortgage on that $400,000 loan at 6.5% interest, your monthly payment for principal and interest would be approximately $2,528. Now, let's look at the 50-year mortgage. Your monthly payment would drop to about $2,256. That is a savings of $272 every single month. It could cover the cost of utilities. It could cover the cost of groceries. It could cover the cost of a car payment. But this is only one part of the equation. This monthly savings is not free money. It is a financial illusion. You are not actually saving anything. You are simply deferring the payment of your debt. Think of it like making only the minimum payment on a credit card. One of the primary reasons to buy a home is to build equity. With a 50-year mortgage, this entire process is slowed down to a painful crawl. In the early years, the vast majority of your monthly payment goes toward interest. After 5 years of making payments on a 30-year mortgage, you would have paid down about $30,000 of your principal. Now consider the 50-year mortgage. After the same 5 years, you would have paid down only about $12,000. That is less than half the equity. You are essentially renting money from the bank at a very high cost. Now it is time to look at the most shocking number of all. With the standard 30-year mortgage, you will have paid $510,080 in interest. Now, let's calculate the total cost for the 50-year mortgage. The total interest you pay is a breathtaking $953,600. The 50-year mortgage would cost you an additional $443,520 in interest. You are paying nearly $500,000 extra for a slightly lower payment. It is a disastrous financial trade-off for the borrower. You are not just buying a home, you are signing up for a lifetime of debt that makes it significantly harder to build real wealth. It is a path to permanent debt, not prosperity. Financial experts are sounding the alarm, and their warnings are stark. Investment firm CEO James Fishback went so far as to call the proposal economic genocide against the Gen Z generation. It captures the deep concern that this plan would not help young buyers, but would instead trap them in a lifetime of debt. Beyond the dire financial warnings, the 50-year mortgage proposal faces a formidable legal obstacle. The Dodd-Frank Wall Street reform was passed in the wake of the 2008 financial crisis to prevent the risky lending practices that led to the housing market collapse. A key QM requirement is that the loan term cannot exceed 30 years. Because a 50-year mortgage is well beyond 30 years, it would not meet the QM standard. To make 50-year mortgages widely available, the administration would need to go through Congress, a difficult, time-consuming process. Many housing economists are warning that the policy could backfire spectacularly. The fundamental problem is a critical shortage of supply. The 50-year mortgage would pour gasoline on the fire of housing demand. When more buyers with more borrowing power chase fewer goods, prices go up. The likely result, another surge in home prices. It could create a housing bubble. When a bubble bursts, consequences can be catastrophic. The average first-time homebuyer is 40 years old. 40 plus 50, that's paying into your 90s. Imagine being 85 years old and still having to worry about making a monthly mortgage payment. What happens when a 90-year-old homeowner passes away? The heirs inherit not a home, but a debt. This proposal tears at that fabric. It suggests a future where debt is a permanent condition from young adulthood into extreme old age. The group with the most to lose is the younger generation, Gen Z and millennials. They sign the papers, relieved and excited. They're homeowners, but at what cost? Their financial mobility is crippled. Instead of a ladder, it becomes a longer chain. This is not a genuine solution to the housing crisis. It is a dangerous illusion, a financial gimmick. This small monthly saving is a Trojan horse. Hidden inside is a catastrophic cost, a near doubling of total interest payments. The warnings are coming from all sides. Financial experts, legal analysts, housing economists. Conservative voices and Republican lawmakers have broken ranks to condemn the idea. The time has come to demand a more serious and honest approach. Shift focus to policies that meaningfully improve housing supply and affordability. We are calling you to action. Your voice is crucial. First, contact your representatives in Congress. Tell them to reject any legislation that would enable risky 50-year loans. Finally, advocate targeted responsible help for first-time buyers. Expand down payment assistance programs. Strengthen proven programs to help people into wealth-building 30-year mortgages. The choice is clear. Accept permanent debt or demand real solutions that restore homeownership as a pathway to the American dream. The time to act is now.